Hello there. I hope that you are doing well. In today's lecture, I'm going to share with you how time cycles influence market swings. I will share with you what the time cycles are and how we can utilize these time cycles to frame high probability trade setups. I will share with you examples that were all of the past week, meaning all of these examples that you will see during today's lecture occurred the past week of the time of this recording. If you will see how many freaking times time cycle logic, that's a bit of a wordplay there. If you see how many times time cycles logic could have been utilized to frame high probability trade setups in the past week, you will understand how many freaking opportunities there are each week. I promise you that at the end of today's lecture, you're going to have a completely different perspective when it comes to liquidity and what liquidity pools to use as points of interest or as draws on liquidity for your ideas. Before we begin with today's lecture, I must share with you the following. When I was studying on the ICT and I was going through his mentorships, I was always wondered why he was targeting very specific highs or lows as his draws on liquidity. One point, I realized that the reason why he's targeting those specific levels is because those levels are time-based liquidity pools. Everyone is so focused on the price patterns. Everyone is so focused on just, okay, what's the high formation or what's the low formation? Why would that be a draw on liquidity, etc. What you need to understand is that the reason why that specific level is the draw on liquidity is because it is time-based, and that is what I'm going to show to you during today's lecture. Buckle up and let's begin. Before we dive into time cycles, you must first understand and believe that market swings are not random. From a young age, we get taught that all financial markets are random and that the fluctuations on them cannot be predicted or cannot be timed. There's this common saying that the markets cannot be timed. I believe the opposing. I believe that market swings are not random. I believe that every single tiny fluctuation that you see on the markets is absolutely programmed and engineered in advance. I know that this goes against everything that we have been taught from a young age, everything that we've been taught by the media and by everyone around us. However, when you begin to see the signatures that I will showcase to you week in, week out, day in, day out, during specific time windows, you tell me that that is buying or selling pressure or act of randomness. It can't be. And that is the belief that I want you to hold on to whilst I explain to you what I'm about to explain to you. Even if you believe that market swings are random, please just for one moment in your life, try to listen to the following and try to investigate what I will share with you. You won't regret it. Trust me. First of all, the interbank price delivery algorithm IPDA delivers price efficiently. This is very important to understand because you need to understand that the interbank price delivery algorithm, which I will now refer to as IPDA, has one function, and that is to deliver price efficiently, meaning at the right times, price should be booked at these prices, and it should rebalance old inefficiencies and draw towards liquidity pools. IPDA refers to time-based liquidity pools. That is what we will focus on during today's lecture. These time-based liquidity points are algorithmic reference points, meaning during the current time cycle, we already refer back to the previous time cycle, its respective high and low. That is what I will share with you during today's lecture. These algorithmic reference points are important during the current time cycle. They provide structure to us to know where buy-side and sell-side liquidity is resting, which we can utilize to trade off. The highest probability trade setups contain the following. They contain a very specific time cycle and they contain a very specific signature in price action. When you combine the both, this can lead to great precision within the markets. First of all, we're going to take a look at a bullish example. What I need you to understand is that during the current time cycle, we can already refer to the previous time cycle, its respective high and low. When this current time cycle opens up and the underlying idea is that we should reprice towards the upside, meaning the market should go higher, we will wait for the market to open up, drop lower, taking out the previous cycle low, forming a low below that previous cycle low, to then begin distributing towards the upside. We see the market accumulate, manipulate, distribute. What do we target? We target the previous cycle, its respective high. That's the nearest term buy-side liquidity objective. This fractal occurs when the underlying idea or narrative is higher prices for that particular window of time. For the opposing side, meaning a bearish scenario, it would look like the following. Where we anticipate lower prices to take place and we see the market open up during the current time cycle, and we already know where the high and low are of the previous time cycle, we anticipate the market to run up higher to take out the previous cycle high. This is manipulation which is taking place. When the market then rejects this high, we anticipate the market to distribute towards the downside to draw towards that previous cycle low. This is the nearest sell-side liquidity objective. Ideally, we want to either position ourselves above that previous cycle high if we're bearish, or in close proximity to it when we displace through that high. This is something I will discuss later on. What I need you guys to understand is that what I have literally drawn out in front of you occurs every single day, multiple times. What I need you guys to understand is what I've drawn for you in these schematics is fractal, meaning this occurs both on the higher time frames as the lower time frames. You can even go as crazy as going down all the way into the 1 minute charts, but just like it would also work on a daily chart, for example, all you would have to do is pay attention to a bigger time cycle then and use that time cycle, its respective high and low, to determine the next draw liquidity. Do you now all of a sudden understand what points of interest and what draws on liquidity to use simply by these two schematics? If you don't yet, no worries. I will touch on this more later during this lecture. What is crucial to understand is that the current time cycle determines how the next time cycle will deliver. That next cycle then determines how the cycle after that cycle will deliver. Meaning, based on how this current time cycle deliver, we can anticipate, listen closely, we can anticipate how the next time cycle is likely going to deliver. Meaning, if the current cycle consolidates, what can we anticipate during the next time cycle? We can anticipate the next time cycle to manipulate into, for example, the buy-side liquidity engineered during that consolidation to then distribute towards the low of that previous consolidation. That's a Birds and Revert model. However, what you also need to understand is that the previous time cycle determines how the next time cycle will deliver, but during that next time cycle, we refer back to the high and low of that previous time cycle, because they are true points of interest and true draws on liquidity. This is how you basically objectify your trading completely, just by paying attention to time-based liquidity pools. What you need to understand is that we keep on referring to the previous X high, PXH, and the previous X low, PXL. During the current time cycle, we refer to the high and low of the previous time cycle. X is the variable which can be adjusted to your choosing, meaning this is relative to your style of trading. When you're a swing trader, you pay attention to bigger time cycles. When you're an intraday trader, you pay attention to smaller time cycles. These time cycles could be, for example, weekly, daily, session, 90-minute, 30-minute cycles, etc. The cycle length is up to your choosing. When you align yourself from the bigger time cycles all the way to the lower time cycles within an underlying narrative of, for example, higher prices, meaning when a higher cycle shows to you that the order flow is bullish and the lower or smaller cycles confirm this to you, then you have a very high probable setup because everything is aligned with one another to confirm to you that higher prices are likely going to be next. Let's take a look at the daily delivery. What is very important to understand is that Asia determines how the London session will deliver. The London session determines how the New York morning session will deliver. The New York morning session determines how the New York afternoon session will deliver. Are you beginning to see how we can utilize the current session to anticipate how the next session is likely going to deliver? During that next session, we refer to the high and low of the previous session, meaning during London, we refer to the high and low of Asia. During the New York morning session, we refer to the high and low of London. During the New York afternoon session, we refer to the high and low of the New York morning session. Are you beginning to understand how we can utilize time-based liquidity pools to already objectify our analysis for the current session? When it comes to daily delivery, these are the session times I adhere to. Before I showcase to you these session times, I want you to understand that these are the session times that I prefer to use. Your session times might be different, and it doesn't mean that the logic that I will share with you doesn't work on those session times. It just means that these are the times I have found to be the most accurate for PXH and PXL theory. The Asia session to me is from 6 p.m. to 2:30 a.m. During the Asia session, I do not trade and I do not really care what occurs. All that I care about is where the Asia high and the Asia low are going into the remainder of the day. The reason why my Asia session is so long is because Asia to me is simply the printing of time and the booking of price within usually tight ranges. When Asia expands, that's very significant because that shows to me that during the morning session I already need to be cautious. But that's a topic for another time. If we pay attention to the London session, we can see that the London session for me is from 2:30 a.m. to 7 a.m. Notice that we have 3 cycles of 90 minutes in here. The New York morning session is from 7 a.m. to 11:30 a.m. The New York afternoon session is from 11:30 to 4 p.m. The reason why my time cycles are split up this way is because these cycles provide me with the ability to utilize 90-minute cycles during the London, New York morning and New York afternoon session. When I look at the delivery through the perspective and through the lens of 90-minute cycles, I can see clearly where the key highs and lows are, and that is what I will showcase to you. We're now going to take a look at the first chart example of today's lecture. What I want you to see is that the London session delivered right here. The London high formed here and the London low formed here. The New York session opens up at 7 a.m. and initially runs higher. It engineers buy-side liquidity below the London high. Do you see how these highs right here are relatively equal? Do you also see how the Asia high that formed in advance of the London high was not taken out right here? I did not annotate it, but you need to understand that in advance of 2:30, we of course have the Asia session. The Asia high formed right here, London high, and the short-term high which formed during the beginning of the New York session formed right here. We have multiple key highs engineered right here, and therefore that's engineered buy-side liquidity. The market runs lower and takes out the London low. By taking out the London low, we reprice lower into this BC right here. I did not annotate it, but you need to see this imbalance right here. We also take out the sell-side liquidity here, which can be investigated on your own. The market eventually forms a low here and then begins to expand towards the upside. What is a key strong liquidity? The London high, of course. Do you see how we went from the London low to the London high? That is one setup based on the London session during the New York session. If we pay attention to the morning session then, through the perspective of 90-minute cycles, we can see the following cycles. The first cycle is from 7 to 8:30 a.m. The second cycle is from 8:30 to 10 a.m. The first cycle determines how the second cycle will deliver. During that second cycle, we refer to the high and low of that previous cycle. After the second cycle, we have the third cycle from 10 to 11:30 a.m. The way that the third cycle delivers is influenced by how the second cycle from 8:30 to 10 a.m. delivers. Therefore, when the third cycle opens up, we pay attention to the high and low that formed between 8:30 to 10 a.m. Do you understand how we can look back into the past to see where the high and low of the previous time cycle formed to determine our draws on liquidity and our points of interest? When we take a look at the following example, we can see that at 8:30 a.m. the market runs up higher. It forms a high near the end of that time cycle. This is the second cycle of the morning session for your info. And we can see that the London high was already taken out right here. What do we know now? We now know that the market is in a deep premium relative to the daily range. The market opens up at 10 a.m. during that third cycle, and what does it do? It initially runs lower, forms a low, and then manipulates above the previous cycle high, above the high of 8:30 to 10 a.m. Smart money sells short up here. I went short here as well on Monday, and we then begin to reprice aggressively towards the downside. What's a key sales at liquidity objective? A key sales at liquidity objective is the low of the previous 90-minute cycle from 8:30 to 10 a.m. And here's something interesting occurs. We reprice below that low. This is our short-term strong liquidity, and the market retraces back into that low. Do you see how the market finds resistance inside of this upclose candle, which was the candle which formed that previous cycle low? The market retraces into that, finds resistance there, and then slams lower one more time. When the market trades below the previous cycle low, it has to find resistance there in order to continue lower. A little gem for you in here. Now, if we pay attention to the morning session in its respective middle cycle, and we split that 90-minute cycle up in 3 30-minute cycles, we get the following cycles. We get cycles from 8:30 to 9 a.m., from 9 a.m. to 9:30 a.m., and from 9:30 to 10 a.m. You need to understand that the same logic that I described to you earlier during this lecture applies to the smaller time cycles as well. It's all fractal, guys, and that is what I'm trying to showcase to you during this lecture. If we take a look at the following delivery, I want you to see the following. At 7 a.m. the market opens up here and begins consolidating, as you can see. Between 7 to 8:30 a.m. the market is in a consolidation. I love to see this, and this is a very high probable signature in my opinion when it comes to the morning session. That's something you need to investigate on your own. At 8:30 a.m. the market runs lower and takes out the low of that consolidation. Between 7 to 8:30 that low formed, as you can see. The market forms a new low and then retraces. We form this high and the market slams lower. We form a new low that is below the low of 8:30 to 9. It's this down close candle that takes out that previous 30-minute cycle low. And here's something very interesting occurs. What I need you to see is that at 9:30, which is the opening time of the irregular trading hours, the market opens up, forms a low below that previous 30-minute cycle low. Let me just summarize this for you. We're trading below the 7 to 8:30 low. We're trading below the low of 8:30 to 9. And we're trading below the low of 9 to 9:30. The market opens up, forms that low, and immediately begins to reprice towards the upside aggressively. What are the draws on liquidity? The draws on liquidity are, of course, all those previous 30-minute cycle highs. But because the previous 90-minute cycle high, which is right here from 7 to 8:30, is in such close proximity, we can anticipate the market to gravitate towards that. Smart money reversal right here. This is terminus of the market maker buy model with an original consolidation being right here. Sell set of the curve, buy set of the curve. Little MXM logic in here as well. Do you see how we were in deep discount? Not only because we traded below that previous 90-minute cycle low, but also because we were consistently trading below the previous 30-minute cycle lows. What do you see? The 3 drives pattern where we form 3 lows and then reverse is present right here as well.
Cause I don't give a fuck what you say. Yeah, I'ma do shit my way. So you can go kick rocks, I'ma stack bricks up, build what I want to make. Yo, I got a lot of shit to say, so I'ma do this every day. I'll be writing things until I'm fucking buried in my grave. 6 feet deep under, but my body won't decay. Cause my messages are timeless, so they'll put them on display. Oh yeah, I rap with a certainty, I have a sense of urgency. A message for eternity, for everyone internally. I had some people burning me, but now they fucking learn to see I ain't the one to fuck with, now they looking nervously. And I don't really care what you think of me respectfully. You can kick rocks if you think you're fucking better, see. I will outwork you, turn you to an enemy. Hurt you so bad that you're gonna need some therapy. I got the motherfucking recipe. I've been cooking up hits, I'ma leave a legacy. You'll be looking small when you're standing right next to me. I'm 5'10", bitch, but I'm 10 feet next to me. I don't give a fuck what you say. Yeah, I'ma do shit my way. So you can go kick rocks, I'ma stack bricks up, build what I want to make. Cause I don't give a fuck what you say. Yeah, I'ma do shit my way. So you can go kick rocks, I'ma stack bricks up, build what I want to make. Yeah, I'ma do it my way. Yeah, I'ma do it my way.
I can't contain it, I'm coming out with a statement. You really changed, man, all your music and arrangement. You don't know shit, shut your mouth, you can save it. I'm the same dude that got his come up from the basement. 100 songs, 100 weeks, didn't change it. Experiments, development, intelligence, and patience. I'll do it all again, cause I never feel complacent. Let's keep the good vibes, positivity's contagious. I'm never looking back, cause I made a life that's passionate. A college graduate suppressing all his talents, yeah. He found a way to go and change, become an advocate. For taking control of your life, go out and battle. And you think you have a dream, then act on it. Get after it, get out your head and fucking capture it. You got one life to master it. Don't give up on your future, we all start losers. We're all late bloomers, gotta
I
struggle
don't
through
give
the
a fuck
sewer.
what you say. Yeah, I'ma do shit my way. So you can go kick rocks, I'ma stack bricks up, build what I want to make. Cause I don't give a fuck what you say. Yeah, I'ma do shit my way. So you can go kick rocks, I'ma stack bricks up, build what I want to make. Yeah, I'ma do it my way.
The following delivery that we're going to take a look at, I've already broken down on my YouTube channel under the lecture called Aligning Time and Price, Market Maker Sell Model Breakdown. I would highly advise you to watch that lecture because it is a very valuable lecture. However, let's take a look at the application of the time cycles in this example. What I need you to see is that between 8:30 to 9 AM, we form the low of that time cycle here and the high of that time cycle right here. We see the market open up at 9 AM and immediately reprice above the high of that previous 30-minute cycle. At this moment in time, our minds should immediately think, okay, we're trading in a premium. Why? Because we are also trading above the high of 7 to 8:30, which is showcased by this red box. The market reprices higher, higher, higher until it reaches a key price level. This key price level was outlined in advance, as you can see within that trade breakdown lecture. The market reaches that level and then rejects it. It begins to roll over. What I need you to see is the following. I need you to see how we close below that 8 to 9 o'clock high right here when 9:30 comes along. The market retraces into a CB which formed right in advance of 9:30, forms a high there, and then immediately displaces towards the downside, creating a CB that displaces through that previous high. The market retraces into that price level of that old high and into that CB and rejects it right away. What can we potentially target? We can potentially target the low that formed between 8:30 to 9 AM. This was also the CPI low. Do you see how this is an AMD fractal, meaning the first 30-minute cycle accumulated, the second 30-minute cycle manipulated above the high of that accumulation cycle, and the third cycle distributed lower towards the low of that accumulation cycle. These cycles represent AMD. Investigate that. If we then pay attention to the morning session, its respective final cycle, and divide that 90-minute cycle in 30-minute cycles, we get the following times. We get first of all 10 to 10:30, 10:30 to 11 AM, and 11 AM to 11:30 AM. Here we can see the market open up at 10 AM and it's dropping lower initially to form this low. Once this low was formed, the market began to expand towards the upside aggressively. What I want you to see is that between 10 to 10:30, this is the high that formed. 10:30 comes along, meaning a new cycle opens up, and what does it do? It runs towards the upside initially, taking out that previous 30-minute cycle high. Once this high was taken out, we can see the market reject it right away. We reprice towards the downside aggressively. And here comes something for your notes. Every single time that a new time cycle opens up, we do not only pay attention to the high and low of the previous time cycle, but we also pay attention to equilibrium of the previous time cycle, being 50%. 50% being showcased right here, which lines up with this BC. The market expands lower, trading into that BC, into a discount of the previous cycle range, before forming a low and then slowly gravitating towards the upside, as you can see. 11 AM comes along, and what does 11 AM do? 11 AM takes out the low that formed prior between 10:30 to 11, and we then begin to see the market run up higher, taking out that previous 30-minute cycle high. When this previous 30-minute cycle high gets taken out, the following occurs. The market forms a new high and then again rejects it towards the downside. Do you see how these 30-minute cycles were consistently being used as algorithmic reference points during the next time cycle? That is key information that you need to begin paying attention to, just like with the 90-minute cycles. Let's take a look at the afternoon session. The afternoon session to me is from 11:30 AM to 1 PM. This is what I refer to as the lunch cycle. This is the first PM cycle. The second cycle is from 1 to 2:30 PM. This is to me the second PM cycle. The third cycle is from 2:30 PM to 4 PM. This is the third afternoon cycle, or the third PM cycle. In the following delivery, what we can see is that the market runs up higher from around 1 PM. Higher lows are being created and there's a lot of back and forth going, as you can see. The reason why I mention this is because you need to understand that when a retail-minded trader looks at this delivery or looks at these fluctuations in price action, they see one thing and they see an uptrend. And they seem to believe then that the market should continue to go higher forever. Meaning what they do is they draw a trend line underneath these lows, a diagonal trend line, and they extend that all the way to the right. What they then think is that they can just go long, market long, and place a stop loss below that trend line. That is engineered sales at liquidity, guys, and that's very important to understand. Then near the end of that 90-minute cycle, you can see the market begin to consolidate. It's going back and forth, back and forth, back and forth, back and forth. 2:30 PM comes along, and what does it do? It opens up and immediately takes out the high of the previous 90-minute cycle. The gray box or the dark box that I've annotated here represents the market trading above that previous cycle high. What I need you to see is that only the wicks went above it. The bodies stayed below it. And that's significant because it shows that price is being held inside the range of the previous cycle. The wicks do the damage, the bodies tell the story. Eventually what occurs during the next macro, which is from 2:45 to 3:15 PM, you can see that the market reprices towards the downside aggressively, meaning it slams lower. This is a massive move within one minute candle, as you can see. What do we reprice into? Into the low of the previous 90-minute cycle. So let me just make that clear to you. We took out the previous 90-minute cycle high, the second 90-minute cycle high of the afternoon session, and we repriced to the low of the previous 90-minute cycle high, the second cycle of the afternoon session. We take out the low and immediately reject it to trade back into the range that was established to eventually close the day. Guys, you tell me that these reactions right here to that buy side liquidity pool and the reaction to that sell side liquidity pool during that macro window is random. You tell me that a lot of sellers are stepping in at this price level at exactly that time when you anticipate a high formation to form, or that exactly a lot of buyers are stepping in at this time where you anticipate a low formation to form. Guys, at some point you must come to terms with the fact that this is simply a game which is being manipulated every single day. And when you begin looking at these very specific time-based liquidity pools, you will eventually come to realize that everything I'm saying during this lecture is true. Remember, all the examples that I'm showcasing you now were from the past week at the time of this recording. How crazy is that? How crazy is that to understand that during the past week, there were so many freaking times that there were opportunities utilizing these time-based liquidity pools. Now, if we pay attention to the final cycle of the afternoon session, the final 90-minute cycle, and we divide that into 3 30-minute cycles, we get the following times. We get first of all 2:30 PM to 3 PM. Secondly, 3 PM to 3:30 PM. And thirdly, 3:30 PM to 4 PM. Now, what's interesting to note is that the second and third cycle of this 90-minute cycle are the power hour. Meaning, this is the final hour of trading for the day from 3 to 4 PM. There's some interesting signatures that we can be looking at to confirm how power hour is going to deliver. Here we can see the following delivery, where we can see that during 1 to 2:30 p.m. we formed the low of that cycle right here. Notice that we formed these relatively equal highs up here during that 90-minute cycle. 2:30 p.m. comes along and we immediately take out the low of the previous 90-minute cycle. We take out that low and the market begins to show the signatures of wanting to form a low. However, we form that low and the market fails to displace towards the upside. Instead, we reject this long wick and the market continues to roll over. The market goes back and forth, back and forth, back and forth, back and forth. What do we anticipate now? We anticipate that 3 p.m. opens up and takes out that previous 30-minute cycle low. Relatively equal lows have been engineered. This is engineered sell-side liquidity. And when these lows get taken out, we anticipate the market to reverse from there to then draw higher. I personally went long inside of this low formation here and I pyramided all the way in this area below the 3 p.m. open. I shared the execution video on my X profile or on my Twitter profile if you may wish, and you can watch it there. The market begins to run higher and notice that it engineers buy side liquidity here between 3 to 3:30 p.m. in advance of equilibrium of that previous cycle range. Notice that we traded above the high of that first 30-minute cycle. This up-close candle is that high. This up-close candle is also a bullish breaker. Why? Because we have a low, high, low, higher high. Now this up-close candle has to function as support on price, right? Not only because it is the bullish breaker, but more so because it is the previous cycle high. We see the market retrace into that up-close candle and find support there. The wick goes below it here, but the bodies keep on closing inside of it. Eventually the market reprices into equilibrium of that previous cycle range, and we can see the market begin to consolidate. Consolidation can be anticipated at equilibrium, as you know. Notice that we also took out that previous 30-minute cycle high. Personally, I took a partial the moment that the market wicked higher here, and eventually my trailing stop got hit. I did not like the rejection of equilibrium eventually, but what I want you guys to understand is that this low formation right here was beautifully done according to the logic of the time cycles, where we were trading below that previous 90-minute cycle low, below that 30-minute cycle low, so we anticipate that the market will eventually form a low, even if we're just going to chop around during the final hour of the day. The final chart that we're going to take a look at during this lecture is the following. What you need to see is that between 2:30 p.m. to 3 p.m. the market initially runs up higher and forms this high. This day was very bullish, so the moment that we had this rather slow reaction towards the downside and we begin to see the market go back and forth, back and forth, back and forth, back and forth. To me that was suspicious because we still had higher time frame objectives or key levels which had to be reached. Therefore my anticipation was the following. I was anticipating that we would open up at 3 p.m, drop lower to take out the previous 30-minute cycle low, form a low there, and then begin to show the signs of forming a reversal here to begin to expand towards the upside. Notice that when we traded above equilibrium, the market went back and forth for a moment before expanding into the anticipated direction. Notice that we took out the previous 30-minute cycle low right here. This is where I went long off, and we reverted towards the previous 30-minute cycle high right here. If you want to see my full breakdown, you can refer to my X profile and see it there. Now, what I want you to understand, guys, is that during this lecture, I've shown you examples of the past week's delivery. Have you seen how many opportunities there were present? And understand that I only have showcased a few of the opportunities that were present, meaning there were loads more utilizing this logic. One more thing that I want to end today's lecture with is the following. Begin paying attention to intermarket relationship the moment that the market takes out the previous cycle low. This is not all there is to time cycles. This was just an introduction lecture. There's way more that we can be paying attention to when it comes to these time-based ranges. However, I hope this lecture has provided you with some insights and the required knowledge that you can utilize to go into the charts and investigate for yourself. Even if you don't believe in the predetermination of the swings that take place in these markets, I would highly advise you to still investigate what I shared with you. See for yourself whether or not there's any validity behind the things that I've shared with you. That is a key takeaway. Think for yourself, and if you want to research more about time cycles, I would highly advise you to watch the following lecture that I released in the past. I wish you all the best and look forward to catching up with you in the next one. Please let me know if you want to see more lectures like these in the comments. Be safe.
Your teaching and your content has made me 100-fold better as a trader.
I'm maybe 4 months or 5 months in your mentorship. I've saved myself years. It's been incredible.
Now I actually have a model. I look in the markets with a different perspective. I can anticipate where the DOL or what our DOL is for the day.
I don't think I would be where I am right now without your guidance and help along the way.
Like, my eyes are so open to the market. I'll predict something and I'll see it happen.
You gave very specific guidelines, and within that I noticed it made even backtesting a lot more simple.
I know exactly when to look for trades and when not to look for trades.
You should be paying a lot more for this information and the way that you break it down.